what has been your experience, good and bad, like over the years, or if it's just something you're totally like,
It's something I've never really dove into. I've always stayed with the infinite banking style kind of stuff, the high cash value life insurance. I've never really delved into the world of velocity banking. I think I know enough about it to be dangerous, quite frankly.
Okay.
I wouldn't even be able to articulately explain to somebody all of the nuanced benefits of velocity banking.
Was there ever a time in your life where you were in like a lot of debt personally, or has debt ever been an issue?
No, not really.
Okay,
I mean,
that's probably why then.
no,
Yeah.
no, yeah.
Yeah, Tyler,
You
you've
have?
been in a lot of debt.
Yeah.
So what was a strategy you used to get out of debt? Was it just Snowball, making extra payments?
Yeah, mainly I use more like the Snowball, and I increased my
Increase your income. Yeah.
I worked on this. I mean, it was when I was in college, and I was learning. So I picked up 2 part-time jobs, and then
Okay.
I realized like I can't keep going down that path, So that was.
So it was a matter of grinding, hustling, and then boom, once you're done, you're like, I never deal with that. Right.
Yeah.
Okay.
It took me a long time to get out.
What about you, Seb? Was there ever a time in your life where you had like a lot of debt?
Yeah.
And then like,
And
what came first, and then?
That is still something I'm working through.
Okay.
Yeah. So, but definitely in control of it, right?
Mhm.
Versus there was a time where it was out of control, And so, for me, focused until I met you and learned about velocity banking, it was really just that Snowball
Okay.
and really focusing on increasing income.
Gotcha.
Like, primarily focusing on income.
Got it. So I'm the weird one here because when I was 18, it was around when I got my first job. And also around the time I got my first credit card, Wells Fargo, secured $300 credit card, right? Used it to pay my phone bill each and every month. Nobody told me to get the card. Nobody told me about credit cards. It just kind of came up. I think I was at the T-Mobile place, and the guy was like, you could pay this with a credit card, or you want to use a credit card or debit. I was like, I didn't even know what a credit card was at the time. Just like clueless. I get it. And, I think it came with cashback rewards or something like that. So I'm like, I got money back for paying this bill. I could have used the cash, right? Or use the card and get a little money back for the same bill. So somehow that was like the seed, right? Then you fast forward, I start taking on debt like any young person naturally would. Particularly in my household, the way I was taking on debt was out of necessity. Whether it was mom or stepdad, somebody always needed money in my family. And so I was the one that would save the pennies, nickels, and dimes, the quarters, stack them up, and then go to the machine, convert it into cash, give it to my family. Here you go. Here's food for groceries. Here's food to cover the card payment, whatever it was.
Yeah.
But then I was like, what if I go to the bank and maybe ask them for a higher credit line? It was just like
it just happened.
Just happened, right?
Yeah.
And they gave me $1,000. Just increased it to $1,000. I was like, so now I have $1,000 to give to my family in the event that they need it. And then when they have the money, they can pay me back within 30 days, hopefully, and I won't pay any interest. And so, but there was times where they didn't pay me back. I was working at my job, and I said, what if I dumped my income into the credit card? I don't have any other bills that can't be paid with a card. So then I did that. No interest. Come to due date. No interest was charged. Had cashback rewards. Threw it on there to help bring down the balance, and just kept doing that over and over again. And then when they finally paid me back, it actually replenished my savings. Right? So it was like I was just kind of just parking money in a credit card. Fast forward. Then I started getting into more debt because I'm like, I need to get a car, or I need to, I'm trying to start a business.
Life
I'm
happens.
like, life happening.
Yeah. Totally.
One day I get a personal unsecured revolving line of credit. Again, no one told me to get this. Got $3,000.
Something in the mail?
I think it was something in the mail, or it must have been.
I think I get like
actually,
5 of those a week. It's nuts.
There were actually credit cards and loans, and then I think I just did research online, and then I saw with Bright Star Credit Union, my local bank, right?
Okay.
Here.
Mhm.
I go in there. I was like, hey, I'm looking at that personal line of credit you got. It's a 9% rate,
Okay.
interest rate, 9.99.
How long ago was this?
This was 2019.
Okay.
You know.
Cool.
No, I'm sorry. Go back. This is 2016.
Okay.
2016, 2015. So that's a high rate.
Yeah.
You know.
Yeah.
Then.
Back then.
Yeah, when rates
for
were
sure.
extremely low.
Right now it would
But-
be low for that, but
I used that 3,000. I tried to invest and make money and do all these different things. And then I'm like, what if I dumped my income into the line? And I noticed how it said I was at this rate, this 9.99, but I was only getting charged $1, or $4, or $2, like
mm-hmm.
in an entire month. It was like $20-$30. I was kind of doing the full math, and I'm like, I don't think I'm paying $9. Let me keep dumping my paycheck into here. Let's see if it reduces the rate even further. And then come to find out, I'm paying like a net actual cost of like 2%, 3%. It's lower than anything else, right? So then, you know, I had other debts. I had a personal loan, and I saw that loan was charging me more than what the rate said. The rate was 10 point something. But when I look at the longevity of that amortized loan, I'm actually paying 27% over the long haul.
Wow.
Because it's amortized.
Yeah.
Right? Versus the simple interest, it's calculated daily, and it needs time to accrue. The interest needs time to accrue. So if you don't give it time, no interest will accrue.
Right.
So it just like, and then finally YouTube comes along. Boom. I see it. Velocity Banking.
Mm-hmm.
You know? And then shortly after, Infinite Banking.
What year did you start your YouTube channel?
2018
Okay.
August,
Cool.
right?
Yep.
So go back 2017 is when I discovered Velocity Banking, hanging
Okay.
out at a real estate group.
Nice.
Renatus is
Yeah.
the group.
Ha, nice.
So shout out to Renatus. I always give
Yeah.
them credit.
Yeah.
Over the years, I've done deeper research. So the origin of Velocity Banking, I think, is called mortgage acceleration. I think that's the term that's used. Comes from Australia. Guy named Harsh Gill, right? He, along with, in collaboration with banks in Australia, came up with the HELOC, home equity line of credit,
Okay.
or offset account. And he has a book, and so that's where it originated. Then he comes to the U.S., introduces it to the, I guess, different groups
Sure.
or bank systems, and
Mm-hmm.
companies like Renatus and others adopt it. Then
Yeah.
they change the name. Boom, Velocity
Yeah, it
Banking,
becomes a
paycheck
marketing
parking,
thing, right?
Cashflow hacking. Like it's
Yeah, it's no different than infinite
Right.
banking, Cashflow banking,
So I'm
bank
like-
on yourself, become like it's all the
yeah.
same
So I'm
stuff.
like, oh,
Yeah.
people are doing it. This whole time I'm doing it, not even
Yeah.
knowing it's a thing.
That's awesome.
So then I start creating content, right?
Mm-hmm.
And then before you know it, I'm like seeing all the negative. I'm like, why are people calling this a scam? Where's the scam?
Mm.
Right? Because again, from my perspective, I was doing it
You
before
were,
I knew it was
yeah,
a
and
thing.
you loved it, right?
And I was like, oh my God, I'm paying like nothing. I'm talking to my girlfriend, I'm talking to my mom. I'm like, hey, you could do this. You could pay off all your debt right now.
Mm-hmm.
Just throw it in this line of credit, and you can reduce the interest rate. That's really that's how you pay your debt off faster.
Sure.
Plus increasing your income like Tyler did. Plus
Yeah.
working hard. Plus
Yeah.
just adding all those things that we already do.
It's just financial efficiency. Is really
Financial
what it comes
efficiency,
down to.
yeah.
Yep.
That word efficiency, love it because I got that from Caleb. So shout
Yep.
out to him.
I think he got that from me.
You got that from love it. So here I am 5 years later, just case study after case study after case study, and more often than not, I'm showing people how to take their high interest rate debts
Mhm.
and pay zero, so complete offset.
Yep.
Because whatever debt I'm paying off, you were going to pay that interest anyways.
Yeah.
So now all I did was basically I tell people initially we're just consolidating debt.
Mhm.
But now we don't want to stop there and just keep making a monthly payment. Rather, drive your entire income into a line, right?
Okay.
So that's kind of like what it's been like. And the case study on the board here is just kind of showing a UPS driver, husband, or no, he's got a girlfriend, but I think they're going to get married. He's about to retire in 3 years from UPS. So goal is to live in Puerto Rico, buy a restaurant.
Goal.
Yeah, buy a restaurant over there, drink some coquito and the mojitos.
It's funny. We just had a client come through who is a FedEx driver.
Yeah.
And he just retired to Southern Mexico. So
Nice.
Is there something with drivers wanting to get out of the U.S.?
Yeah, I don't know. And then he wants to get, have a little Airbnb business going on over there.
Yeah, that's awesome.
He's got 2 properties here in the U.S., a primary and a rental.
Cool.
That one on the board is a rental, so he's got $112,000 owed on it, 1204. He's making $1,800 or $1,900 or so from the rent.
Okay. So he's cash flowing.
Cash flowing, and it's a 4% amortized.
Cool.
He just applied at PenFed Credit Union.
Okay.
Which is, I believe, the same size, maybe a little bit bigger than Silicon Valley Bank that just went under. So, I also educate my clients. I educate my clients on, hey, pay attention to the health of the banks that we want to do business with. And typically, from what I've experienced, banks that do offer HELOCs, PLOCs, credit cards, revolving accounts that require more money in reserves to maintain those accounts typically have a better health from what I've seen. But then on the flip side, we've also seen from 2013 all the way to 2022, credit unions, small banks, community banks are just disappearing little by little.
Oh, totally.
Left and right. I think there was just under 7,000 smaller banks in 2013. 2022, I just put an email out to my clients and my subscriber base. We're down to less than 5. Right? It's like 4,900 local banks.
Crazy.
So what I tell my audience is I'm like, look, Velocity Banking just got a little bit harder in terms of finding the tools that are out there. Still possible. We're in an environment where the rates are high. We're still making phenomenal results because as the rates go up, so do your amortized loans.
Yeah.
And the average car payment's like $900 now.
Oh, it's absurd.
I'm paying $650 on one and $720 on another.
What's wrong with you?
So when I'm talking to
We're gonna have to
clients,
have a conversation, Tyler.
when I'm talking to clients, I'm saying, hey, if you get a HELOC, you get a PLOC, you're able to control your payments and cash flow that much more effectively. And even if you're in a bad situation, you're able to buy time at a lesser cost than you would getting a loan and having that interest front loaded in advance, right? So for this client, he's looking at PenFed, the rate pretty high, 8.75%, sounds high. 45,000 is the credit limit that they conditionally approved him for. So now he just has to go through the process. And we've got 4 debts that we're looking at eliminating. He's got a Prosper loan. The payment is $611.16. So I'm
the
assuming
cash flow of that is pretty nasty.
Yeah.
I'm 10K.
I'm assuming the interest rate is high on that.
It's got to be high, and it's probably like a 5 year duration and a high interest rate kind of deal.
Exactly. So I told him, I said, get me the interest rates on those loans, but we were just running the numbers, and I was like, look, more than likely, all of the rates on your credit cards and the loan is higher than the 8.75. So just from a consolidation point of view, you're going from a higher rate to a lower rate, but we don't stop there, right? So if you add up the numbers, the loan $9,383, one credit card $1,026. For those that may not be able to see it, I'm just reading it out. Credit card $1,830, another credit card $6,316, and he's paying $200. He's actually probably overpaying on some of them
to pay him down quicker, but it's still not enough.
Not doing much. So I said, look, the total cash flow, you add up all that, and it's like, I don't know, look at my notes real quick.
And he's not actively using those credit cards right now. They're just there. He's trying to pay him down.
Just there, just trying to pay him off.
Cool.
So the cash flow gain, if we were to eliminate them in one shot, it would be $1,211.16. Right?
So he increases his cash flow by that much
Instantaneously.
That's
right?
awesome. Yeah.
So how do we go about doing that? Well, with the $45,000 credit line, this is how much we have to use and leverage. I've got some rules that I share with my clients. I'm like, look, this is what has worked for me personally. The math usually always kind of lines up.
Okay.
I take cash flow times 12 where they're currently at. So his income is $8,050. spending $5,398.25, cash flowing $2,651.75. These are about as accurate as we're gonna get, maybe a little fluctuation here and there. So I say, okay, we take that conservative cash flow.
The 2651.
Yeah, so when I'm working with clients, I underestimate income, I overestimate expenses, I underestimate cash flow purposely, leave room for error, so that we know how to properly leverage debt, so we don't get into any,
Do you have a rule as far as percentage that you overestimate and underestimate by, or
So-
do you just kind of take it case by case?
case by case. But my general rule is typically UPS drivers or truck drivers. I'm like, you have a salary plus there's overtime, bonuses. Don't even give me that.
Mm-hmm.
Just give me your base pay.
Mm-hmm.
So I usually operate off people's base pay.
Yeah.
That's probably the most consistent I could get.
Okay.
When it comes to their expenses, their miscellaneous dining out, I say just round up, not down. Round up.
Yeah.
What's your highest month? Give me your
Yeah.
highest month on each expense, and it usually brings their cash flow way down.
And what do you tell people that like maybe they're having more trouble like budgeting? Do you tell them to get a software? How do you tell them to break that down for you?
So the beautiful thing about this concept when it comes to budgeting, none of my clients actually budget. We just simply look at where did your money go from the last 90 days up to a year. We look at history. So history tells us this is where you're spending money, this is how much you're spending, and this is the average.
Food. Lots
Right.
of food.
So I'm like, it's up to you. So I leave it to the client. I'm like, look, it's up to you if you find yourself overspending on food and or food, dining out,
Do
Uber
they
Eats,
send
whatever.
you statements or do they do like?
Yeah, they send me statements. They'll do that,
Yeah, so here's
or they just do it their own.
that kind of has like a list of things to think about, and then helps them to kind of brainstorm of like, and then you separate your actual debts, like which are loans, credit cards, etc., versus expenses. Those are two different things.
And what's
So
your
that's
thoughts on
different
like Mint and Quicken?
Oh yeah, I'm like, guys, clients, whatever works.
Yeah.
Mint, why, and you need a budget if you're familiar with that one. I'm like,
okay.
whatever works. I just need the real numbers. Don't give me fake numbers, because usually a budget is fake numbers.
Yeah.
If you're budgeting for something, I don't want that. I need what's
Yeah.
actually happening.
Yeah.
Makes sense.
So I'm big on that. From there, my rules are we don't leverage more than 2/3 or 66% of what we
Of the
have
cash
available
flow.
credit. Available credit on the
Credit.
credit limit.
Oh, okay.
Yeah, the
Okay.
45K.
Got it.
The only reason why I would violate that is if your cash flow times 12 is more than 2/3 of the line.
Okay.
But even then, it
Why?
may not be necessary, right?
I know why.
The only reason why we would violate that rule is if there's a cash flow opportunity to
Mhm.
chunk a significant amount because of the cash flow potential that's there. So in his case, our chunk, if we add up these 4 debts, because the only 2 other debts he has is a mortgage, his
Mhm.
primary, and his rental. So I'm like,
Okay.
those are no point in trying to go after it right now. You're not going to get the cash flow. So
Yeah.
go for the lower debts.
Mhm.
And this incorporates that Snowball, that Avalanche, cash flow index, which is something I'm
Yeah.
actually embracing
Yeah,
even
I love it.
more.
Totally.
Not even realize I've been doing cash flow index forever.
Mhm.
But cash flow index actually is a formula that, whereas with my clients, it's just what's up here. It's the gift that I have. I just tell my clients, I'm like, I know it's a gift. God gave it to me. I'm able to look at people's debts and I can just see which ones we need to go after. But cash flow index formula proves my kind of thinking, where it's like you take the balance, you divide it by the monthly payments, you get a number. If that number's below 50, right? Boom.
Got it.
Go in the order. And usually every single time it lines up with what my choices were for velocity banking. But what I tell people is when we're deciding which debts to go after, I'm looking at cash flow first, interest savings second, balance third, but then all 3 simultaneously. And that kind of throws people out. Well, what?
Yeah.
But cash flow index really, really helps.
Yeah. No, it's a great way to kind of decipher.
Exactly.
Yeah.
So add them up. The chunk amount, that's the terminology we use.
Yeah.
Taking a chunk, a lump sum out of the HELOC of $18,555. And you pay off the 4 debts. You now have that cash flow that is going to be parked in the HELOC. So now you don't have a payment no longer on the HELOC because your paycheck is the payment.
Hmm.
And it's being submitted in advance well before the due date. So 2 things that's going to happen with with banks. Some banks will say, okay, Denzel, you don't owe a payment for the next 4 months because of how much you paid up in advance, or 3 months or 2 months usually. Some banks will say, you only need to pay us the interest on the due date each and every month, which is fine because it's the same interest that you're paying over here. I'm just moving it to the HELOC, paying significantly less, and then offsetting it all together.
I see Tyler's face. She's like, I'm just trying to get the numbers worked out in my head. I'm trying to get it figured out.
So here is how you calculate your borrowing costs, right? Because that's the key. You have to know, does this actually make any freaking sense? Let the math show it. So the formula on calculating simple interest, you take the balance, times it by the interest rate, divide by 365, and you'll get the daily borrowing costs for however long you owe.
However many days you have it.
However long you owe $18,555. So when I tell the client, I'm like, look, the borrowing costs on $18,555 is $4.44. How do we bring that to zero?
Per day.
Per day. I'm like, how do we bring that to zero? I'm like, the way we do it is on the day you make the chunk, it's going to be the same day or the day after you get paid, right? So if I get paid on a Friday, that's the day that I have the most money in my checking account. I want to make the chunk that same day. Because, guess what? If I take $18,555 at 8 o'clock in the morning, pay off the 4 cards, it'll usually register same day when you do it in the morning rather than at night. It takes a while for it to process. Your paycheck, say he's bi-weekly, so say $4K. Dump it right into the HELOC same day. That $444 is not going to register.
It goes down, and so then you use the HELOC to live off for a period of time, but your average daily balance is lower, so it saves the $444. It cuts it to like $3 or $3.50 or something of that nature.
So here is the overestimated average. There are some calculators out there that will give it more accurately, but I like to again overestimate for like room for error. So I say, look, you do the highest balance, which is your chunk amount.
Yep.
The lowest balance, which is income goes in, so $10,505, right? And then the ending balance, which is after all bills came out for that month, you'll end up at $14,692.09 if all the numbers are the same.
Wow.
So the borrowing cost on $14K is $3.52.
So you reduced your cost per day.
On $10,505, it's $2.51. So here what we do, we add the 3, divide by 3. Your average daily borrowing cost is $3.49 a day. Times that by 30 days, you're paying $104.70. I guarantee you, he's paying way more over there.
Yes, he is.
Right?
Infinitely more.
Just on that 611.
Yeah. That's awesome.
Right?
So that's amazing. So is there another step to think about for this? I mean, or like what are the tools that you utilize? How do you manage it? Like,
so one of 2 ways. There are some really expensive financial softwares out there that can help with this. The audience that I'm talking to are in their 40s to 55 plus. They have no problem using pen and paper, and so they love that.
And so you do it's like literally handwriting this every month and managing it like that.
Like that, or some will take an Excel spreadsheet. I have quite a few IT clients, and that will literally create the formulas in Excel that I give them. They put it in the Excel, and then they just plug in their numbers, and they illustrate it. And it says, okay, well, this is what it should look like.
Tyler's like, I sense an opportunity.
That saves a ton of time. It does save a ton of time.
Yeah.
But if you're old school, this is what you would do. And you literally go month by month. And once you've mapped it all out, you go to about the line is paid off, right? So you say, okay, this should be paid off in about 4 months, 5 months, 6 months, whatever it is. And then on a day-to-day, the rule is when my paycheck lands, I'm dumping it right into the HELOC. When bills are due, the day before the bill is due, I'm pulling money back out to the checking account to pay the bill that has to be paid with a checking account. Now, to make this even sweeter, you get a credit card with cashback rewards and run all those bills that can be paid with a credit card. We just paid off 3. So I'm like, dude, pick any one of those 3 to the client. I'm like, whichever one is giving you the highest cashback rewards, pick that one.
That's awesome.
Run your gas, your food,
Yep.
your phone, but anything and everything. Get wife on board. Get whoever you can on
Yeah.
board in the household to run all the bills to that central
just-
location. I can bring 104 and probably get 30, 40, 50, $60 in cashback rewards
Cashback and
each and every
benefits.
month. So it brings the borrowing costs, cuts that in half. So if you did the math, on 104.70 times 12 is less than 1,623.56. That's 8.75% over 1 year, right? So when we did the math on this particular client in just under a 4 to 5 month period, the total interest is overestimated 356, around $356. So if you did the math, like what is the interest rate on 356 from 1,600? I'm like, dude, you just cut it below 4 at least. You're like in the low threes, maybe even less than that. Especially when you tack on the cashback rewards. Now you're borrowing at literally 1-2% net in just 4 to 5 months. The debt is gone. Your credit goes up, right? And you're in more control with that home equity line of credit or PLOC, right?